Welcome to this week's Advisor Team webinar. As you know, this webinar takes place every Thursday at 4 p.m. Eastern Standard Time. This is a great time for us to go over the questions you typically have as you go through the Business Finance Suite program and or as you're operating your business. We'll cover topics all the way from marketing to finance and so forth. If you have any suggestions on a topic that you'd like us to review, you can put that in your comments, or you can send us an email, advisor@businessfinancesuite.com. We also record these webinars, so make sure you're following our YouTube channel and you get the notification every time these are posted. Well, let's dive into today's webinar. I was discussing with my team what would be a great topic to discuss that we haven't already gone over. And the topic of, reviewing typical lending terms. Sometimes lenders assume that everybody knows what they're talking about. And I think this happens not because they think they're wonderful, but because they're used to being in their world. It becomes second nature, and they forget that those that don't deal with lending on a day-to-day basis, the terms they use may be confusing or intimidating. So I wanted to make sure that we cut through that confusion and make sure that we can talk that talk with the lenders. Now, keep in mind, even somebody that's been in business for 40 years may not talk the talk of a lender. Okay, so just because you're fantastic at running your business, it doesn't mean necessarily that you should be able to talk the talk. So you shouldn't discount yourself. If a lender says something you don't quite understand, it's fine to ask questions. It's fine to not know exactly what they mean, because as I was doing my research, making sure I was hitting every point, I realized there are thousands. I knew this, but there are thousands of terms they use, and they typically name it something that sounds very official, but it means something very simple. So today we're going to review that as a group and really just graze the surface, hitting the most common terms. And I also wanted to challenge you guys, even from the beginning, go ahead and submit questions. So if you have specific terms that lenders have thrown out at you and you're confused, or you weren't sure then and you think it would be a good thing for all of us to discuss, go ahead and put that in the questions, and we'll talk about those as we're going through each of these general items. Okay, let's get started here. Okay, so A to Z of lending. Let's learn how to talk the talk. So we talked about this. Terms and phrasings can be confusing to everyone, okay? And it's important that we don't just brush by the confusing terms, because think of the repercussions of that. You could sign documents and agree to something that you didn't necessarily intend on agreeing to, or you're going to miss finance opportunities because you don't quite understand how that finance product works. And though it seemed too complex, maybe it was the perfect match for your business. For instance, factoring, that is something that's a little confusing to explain to business owners, but in a lot of situations, factoring is exactly what that business owner needs, but simply how complex it is to explain deters a lot of individuals. And so if the banker is not good at talking normal talk, I don't know how else to explain that, then they could deter those clients that really need that type of financing. So it's important to ask questions, not be too prideful to admit, I don't understand what you're talking about. You need to explain that, step back and explain this to somebody that's not in banking, talking about these things all day long. I fell victim to this too as a lender. You're in this world day in and day out. And one of the hardest hurdles, we would constantly deal with is, we need to speak more plainly. We need to explain things in more detail and not assume everybody understands. So, so you want to try and learn now those common phrases and policies, and then also ask ask questions. So if you're looking into a certain type of financing, I'm a big fan of, reviewing it before you go in to meet with a banker or, talk with a lender. One of the nice things about being in the program is we try and cut through that confusion for our customers, explaining factoring in more simple terms, so we can really imagine how it's going to help the business, and not just more simple, just so you can see how it fits your business, not just a generic discussion. What is this really going to do for your business? I'll never forget, there was a client and they were approved for financing, and it wasn't just a line, or it wasn't just a loan. It wasn't something they were comfortable with that they had used in the past. And, they declined. They were approved for the financing, but they didn't want to take it. And I was baffled. So I'm staring at this going, this is what this customer needs. It's a perfect fit. It fixes their cash flow issues. What's going on? And, I kind of stewed about it, and I thought, I can't let them do this to themselves. I need to figure out what the root is of their decision. And I called and I said, look, I just want to make sure we're helping. So what is it about this financing that you don't want? And it was interesting. What it boiled down to was that they didn't quite understand the financing. And not just that, they had not thought about what the financing could do for them. They didn't realize the change it could make in their business. And so therefore it didn't seem like exactly what they wanted. They just wanted a check, and then they would, spend it the way they wanted instead of this other form of financing. And so although the end result got them to the same place, or even better in the other direction. So, it's important to discuss these things with the finance team or with the lender, so that you're really stepping back and understanding, this is how this can help me. And although I may not have thought about it in these terms, this is really going to help. For instance, factoring, if somebody is gathering funds from a business to business, there's lenders that'll just, here, we'll collect those and we'll pay you your funds up front minus our fee, and that's it. That's how it works. And they do charge you a fee, but a lot of clients are thinking, well, right now I'm gathering them and I'm not paying a fee. But then they don't think about, I'm paying employees to handle these, and I'm mailing out invoices, and there's so many other costs involved. Often those exceed the cost of the fee that lender charges. So just a lot of interesting things, so many different types of financing. It's important to really broaden our horizons in our mind, and see if, all the options out there will really help. Okay. So we have talked about this. We've said this phrase many times, thinking like a lender, and it's important that we step back and think like a lender, and lenders are balancing risk. So, some financing is risky, and if it is risky, the cost is higher. Well, what does that really mean? I say that all the time, but I don't think we all understand exactly what that means, because we have to think like a lender to understand what that means. Now, you can see the fine print at the bottom. I just went through and typed questions after that a lender is asking themselves, because they want you to put yourself in their frame of mind. So this is what's going through a lender's head. Okay, is their business income enough to pay me back? What is the verification of the income? Meaning, how did I verify the income? How do I know that's good verification? Was it fraudulent verification? Did I get to see tax returns? How many years was that income stable? Maybe it was just 1 year tax return. How do I know it's going to be the same next year? So they're thinking about all these details, almost on a level you would think they are a little overly concerned. But remember, they're offsetting risk, and the higher the risk, the higher the cost of your financing. So you're getting in the frame of mind thinking like a lender. Let's keep going, keep listening. It's a long list, but this is going to help you think like a lender and expand that thought process, so you can look at yourself like a lender. Okay, so is the collateral I'm going to take easy to liquidate? Do I have to drive across the country to get the backhoe and then bring it all the way back to the auction that's going to get me the most funds? And I'm only going to get auction price, which is about half of the value. This is all going through their head. Will the collateral hold its value, or is it going to drop like a rock? Is the business going to stay in business? How do I know it's going to stay in business? What is the industry? Can I verify the business existence? Can I go to a location? Can I see them online? How do I know they're real? How is the owner's personal credit scores? Studies show the owner will handle their personal credit the same way a business does. How is the business credit? Do they have any? Can I verify the business there? How is this industry doing nationwide, locally? How many loans typically default in this industry? How much experience does the owner or the partners have? Where is the business located? Are they going to get good foot traffic for that type of business, etc.? Do they have a storefront? If they're selling something, it would be great if people could walk in to buy it. How is that the economy in that area? What variables could change the economy in that location and area? Now your brain is about to explode, I'm sure, and it keeps going. And this is what they really have to think about as they're lending. So, what if the economy tanked? What is that economy based on? Is it based on one factor or many? For instance, Las Vegas, based on tourism as a majority. So if people run out of money to go visit Las Vegas, that economy is hit hard because they're not diversified. They have one typical source of income. That's just an example of how these lenders are thinking. How's the economy in the area? What variables could change in that economy, location, or industry? Maybe an industry will go extinct. And can they anticipate that? If the business fails, what funds could the business owner use to pay them back? Who owns the business? Who owes the business money? Meaning, okay, these guys are getting paid regularly by one company. What if this company fails? Who's paying this business to stay in business and then making it possible for me to get paid? And let's see, what is the target market for the business? Is that target market going to sustain the business? Do they have the infrastructure to grow? How will the business expand? Do they have the ability to contract if needed? What would they cut? What would they cut if they needed to downsize? Could they do it? What would they cut? Is there any room? How long will it take? How long will they have the bank's money? Maybe I don't want them to hold on to these funds for 40 years, but I'm okay with 5 months, and et cetera. This goes on forever. So you get a glimpse of how these lenders are thinking, and then you can step back and look at your business in detail. And these are questions, sometimes we like to glaze over them because, let's be honest, we're running a business. We want to think this is the coolest and best industry and that my location is the best. But the bank steps back and looks at it objectively. And we have to be able to do the same to completely understand. One of the hardest things as a lender was declining a business. I knew they needed the funds. I understood what they were trying to do. And a business owner, so much blood, sweat, and tears goes into it. People are relying on them. And then to decline the business, I could see, the cycle of frustration, and usually resulted in stupid bank. Why didn't you approve me? And sometimes it hits the ego. And the truth is, there were several variables that made them not fundable, wasn't willing to take that risk. And it's not because I didn't like them or because the business wasn't cool. It simply was probably too risky. And maybe as a business owner, it's a good thing to look objectively at your business. It's probably a healthy process from time to time. Okay, so lenders love balancing risk. The whole process of lending is mitigating risk. There's this risk, but it's mitigated by X. And as long as they can mitigate, offset the risk, then you're good to go. Okay, the best way to understand lending is to think like a lender. We said this before. So we step back. We look at the business through the lender's eyes to identify how you can make your business look more appealing. Like we talked about, thinking about the industry, thinking about your economy, thinking about your target markets and where your income's coming from. Is it steady? Can you verify it? Can I verify the business? If I went in and as an objective third party, could I find enough information to really figure out this business is real? How many employees? How long have they been around? How long has the business owner been operating the business? Step back, look at the business and like a lender does. Now let's dive in to our common banking terms. But before that, let's see. We've got somebody whose sound isn't working. Let's see, you could click on your microphone and you may have some options there. Unfortunately, I can't make that work from my end. Go ahead and submit any questions you have right now about common lending terms. And I want to make sure to hit those because there's no way for me to talk about everyone. And so I brought up those that have come up in my discussions with clients, but that may not necessarily be exactly what your questions are. So let's start with the first. And oh boy, this is going to sound like school, isn't it? I'll try and make these real life applications. Accrued interest, what is it? It's simply if you had a savings account and you've earned interest for the month, but they haven't paid you for it. So it's sitting there. They're just waiting to pay you. Adjustable rate. What it is a rate that adjusts. It may adjust daily. It may adjust every 10 months. It may adjust every 5 years. And so it adjusts within the period that was stated when you signed the loan. And it's usually based off an index. And in your loan documents, it would tell you the index. You'll want to know those things. You guys have heard about this. We just went through a sort of mortgage crisis based on some of those principles. And so I thought that was very applicable to bring that up so we all understand it. An ARM, you've heard that a million times. It's an adjustable rate mortgage based on the same principle as the one up before. It's just based on a mortgage. An agent, this word gets thrown around a lot, and I just wanted to bring up the definition so we can actually think about it. It's one that operates on behalf of another. Okay, so real estate agent. There's lots of scenarios where you have an agent and you may not understand that you're working with somebody that's actually operating on behalf of another. So when you go to a broker, they're in a sense an agent for a lender. You want to keep in mind that that is a term that you need to be aware of. It may be something similar to a broker. And it's not the brokers are bad. There's good brokers and not so wonderful brokers, but just you want to stay on top of it. You want to know what's going on. Amortization, that's a fixed payment schedule, typically with principal and interest. So if you took a car loan out for 60 months, you take the loan amount, divide it, include the interest cost for the whole year and divide it up. That's your principal and interest. There's a little more of an art to it, but that's basically what it is. APR. This is a common question actually that we receive, and bankers just throw that acronym along like it's the most common thing ever, but it's the annual cost of the loan. So, but it takes into account the fees. So you have your interest rate. My interest rate on the mortgage would be 4%. But if I calculate in the cost of the financing for the year, it's an annual percentage rate. So if I take into consideration maybe mortgage insurance, other fees that are applicable to that loan annually, your APR will be higher than your interest rate. Okay. An application. I put this on there for one reason, and a typical hurdle lenders run into is just getting that application. I can't stress that enough. They just want a completed one that's easy to read. You do that, you're golden. In fact, I love pretty applications because it's so rare that you get one as a lender. So you want to make a lender happy, make their day, type in your application, fill in every single field, ask questions if you don't know the real answer, and they have to have it in order to apply. Nothing can happen. It will sit there until they get an application. Just because you got it into them, but it's halfway filled out, it's not going to get processed. So, bring a smile on a lender's face and you can get them a completed application. And you know what the word means. I just thought it would be fun to talk about it and what you can do to make a lender's day. Maybe that's a nerdy thing to desire in your day, but a completed application is something that really makes a lender happy. Okay, borrower. That's a term thrown all around. Who is the borrower? It's the person, company, that's borrowing the money, right? So the closing costs are the fees incurred on a real estate mortgage loan. It could also be on another type of loan. That term is thrown around throughout all types of lending. Collateral. This is a word, that I get a lot of questions on. What is collateral? What isn't it? Same with the word assets. It's funny, collateral, the definition of collateral includes the word asset, and that is equally asked. So collateral is an asset, meaning something tangible that the lender can hold or title when they or liquidate if the loan fails. For instance, a car loan. What is the collateral? The car. Mortgage loan. What is the collateral? A house. Inventory. Is that inventory the collateral? Those little items that you have for sale. Yes, inventory is collateral. It's an asset. So sometimes we have to broaden our vision of what collateral is. It's not just a house. It's not just a car. It could be a form of machinery. Could be a dentist x-ray machine. A lot of things can be collateral. Lenders like collateral. Think about it. You're securing your financing with a tangible item. The downfall is you typically can't lend the exact value of the collateral because think about it. It will depreciate. It's used. Typically if they're buying new, once they start using it, it becomes used and will lose value, etc. It's hard to go in and pull out an x-ray machine out of the doctor's office and then sell it on the market for exactly what its retail value is. So collateral loans are great in that your interest rate is usually lower. You're just not typically going to get your loan isn't going to be the same value as the retail value. Okay. And you can see why, because we're thinking like lenders and now we get it. They're not going to give me the full amount on an item if they don't feel like they could liquidate it for that same amount. Let's see if we have any more questions. We don't. Okay. So let's just keep going. We'll go back to our full screen mode here. And, this literally was a 1,000-item checklist, and I just brought it down to those that are common. So conventional loan, I hear this thrown around all the time. What does it really mean? What is a conventional loan? Ask yourself. See if you know the question. That'll wake you up here. I'll give you a moment. What's a conventional loan? It is, in general, if it's a mortgage, it means you meet the standard guidelines that are outlined. The factors that make this deal, they aren't below those lending guidelines. So it's conventional. In general, we could say a lot of banks prefer conventional lending. And then you have your unconventional lending, where those factors are below the typical lender guidelines, and therefore they're more risky. So the cost goes up, but at least the option is there, right? So you want to think about that. Why is that important? If it's not a conventional product and not a tried and true, mortgage loan or something that a bank is used to lending, then the cost goes up, the risk goes up, and you typically have to go unconventional. Now, sometimes a bank may, not be an option because there's no elements that qualify the business for conventional financing. Then we have to go unconventional, but that doesn't mean anything besides, thank goodness there are unconventional methods to get the financing, right? And but you want to be aware that means the cost is likely going to go up. And since you're thinking like a lender, that won't surprise you too much. You just need to make sure that what you're using those funds for really will benefit your business, that you're taking account the cost and that fixed cost or variable cost, and making sure that you're going to increase profits based on those funds, and you're using them wisely. Okay. Debt to income ratio. This is a common question. So that's all of your debt, including new debt. Okay. And that's something usually people will leave out. So you calculate all your debt, you add it up, typically on a monthly basis, and then you compare it against your income. The same way, if you are doing your debt to income on the monthly basis, you will figure out your income on a monthly and create your ratio. Okay. Now lenders have figured out, hey, at 36%, this, this client's doing pretty well. They're going to have wiggle room. They'll be able to pay me back. If it goes beyond this, it's kind of pushing that ceiling. And so, lenders have created these standard guidelines so that underwriters can approve or decline. And all they're doing is looking at all their data going, well, these guys that had 40%, they were more likely to decline than those that had 36. So let's make our rule 36. It's a nice, happy place in the middle. And that's how those kind of factors, those conventional loan factors, come about. Okay, we're continuing on. I'll check in a minute to see if we have any more questions. Depreciation. What does that mean? It's when something loses value. You all know when you buy a car, it loses value over time. About everything loses value over time. Some assets will increase in value over time, and a lender takes that into account. Is this appreciating or depreciating? Okay, factor rate. This one comes up a lot. What is a factor rate when you're factoring or other types of financing? And there could be a lease factor rate, these type of things. It's similar, to be honest, it's not very fancy. It's similar to the calculation of interest. So a factor rate really just includes the cost of funds on a lease or various types of finance. So for instance, if you're leasing a car or a truck, the factor rate is essentially the cost per month that it costs you to lease that item. Essentially, it's the same as an interest rate if you think about it. It's just calculated differently because you're leasing or doing some other type of financing. Okay. Gross revenue. This is something, though we all know what revenue means, what does gross revenue mean? And how do I find that number? So that is the amount. It's typically at the top of your tax return. This is how much I brought in. This is before my deductions. This is before my expenses. This is before I pay for anything. This is how much money comes in. Okay, that's a fun question to answer on a bank application because it's pretty and it's typically a high number because you haven't deducted anything out of it. So when somebody asks for your gross revenue, that isn't after taxes are taken out or after deductions or different expenses. That's before. Okay. If you're not sure, ask the lender. You never, 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 I'm going to say it, never, 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 never want to put a number on an application that you're not confident in, because you never want to run into this situation where a bank is telling you you provided fraudulent information to get an approval. I'm a big advocate of filling out applications correctly. And because at the bottom of that application, all that fine print You're stating that the information you are supplying is correct to the best of your knowledge in general. So you want to make sure you're giving them good numbers. And if you don't understand, you need to ask. All right, a guarantor. That's a good question. I get that a lot. What is a guarantor, a guarantee? What is this thing? And it's basically, and they're easily confused. I should have wrote it on here. There is a term grantor, and then there's guarantor. Grantor is granting collateral. I own a car, I'm granting it as collateral for the loan. A guarantor is I am personally liable for this car loan. So I may be granting the collateral and guaranteeing that I'm going to pay for the payments for the car loan. Okay, so this comes into play when you're in a business. Now, typically most lenders, unless you're borrowing $20 million, and even then sometimes they want a personal guarantee, meaning you're going to be personally liable. If we don't get paid and the business can't pay it, then you're personally liable. So you're going to run into that situation, and it's important you understand what that guarantee means. It's common for me to hear that a client does not want to personally guarantee financing. Keep in mind, banks like to offset risk. So if they can get that personal guarantee, guess what happens to the cost of the financing? You got it. It goes down. Okay, so personal credit, most business owners handle the business the way they handle their personal credit. It gives them a backup way to get their funds back if the business fails, because a huge majority of new businesses do. And so that's the difference between a guarantor and a grantor. Okay, so if you guarantee a business loan, that means you're personally liable if the business can't pay for the funds. It can even report on your personal credit report. And a guarantee is different. Some are more detailed, like for an SBA loan, you may be on the hook even more than a standard guarantee. Okay, so it's important you understand what you're signing. It doesn't mean it's a bad thing. You just need to understand it. Okay, so interest, I get this question. What is an interest rate? It's really the cost of funds typically reflected as a percentage rate. I'll give you money, but I'm going to charge you 5% to use my money. That's what a bank is saying. And so that's the interest rate. Loan to value. So if I give you, so if I'm going to give you a $50,000 loan and the Corvette is worth $60,000, if I create that ratio, that's my loan to value ratio. On car loans, you can usually get 100% loan to value. On other items, you typically won't get 100% loan to value. Car loans, home loans, those typically will do 100%. The others you have a hard time. Not even home loans anymore. That came from 10 years ago. So home loans, you typically have to bring in funds too. So you'll want to keep that in mind anytime something is collateralized. Let's see if we have any questions. See how lucky we are. Nope, no questions. Okay, let's finish this up. And I had anticipated some questions so we could dive into them. I just pulled out the most common questions I get. You can also call the advisor team and they will answer any questions you have on financing. How wonderful is it that you're involved in the program and you don't have to even go through asking the lender and getting their generic answer. You can talk with our advisor team who explains these terms all the time and has really found some great ways to explain it and help you see how the financing could help your business or not. So stipulations. This is a common question I get. So we'll get a preliminary approval. Hey, you're approved for $50,000. Here are the stipulations. I need a copy of your articles of incorporation, bank statement. I need a copy of your driver's license and so forth. Those are stipulations. Now, it's important to understand, yay, I'm approved. But if the documentation I submit does not give them the information or does not support their answer, then the approval amount can go down. It can result in a decline. The lender's not on the hook. It's pending the review of the stipulations. And so you want to make sure you understand that. If you have an approval, I always tell clients, don't count your chickens before they hatch. You've got to wait until it's in your checking account until you celebrate. So for instance, if a lender asks for tax returns, that means those numbers have to check out. They have to compare well with what's on the application, and there may be little surprises. Another thing I want to bring up is don't give them more than they asked for. Sometimes, you may cause a situation where you get a decline based on a document that you submitted that you didn't even have to send in. That happens on mortgages quite a bit because you're being over responsive and you just think, I'll just send them everything and then they don't have to ask me for anything. That can actually hurt your cause. So you've got to make sure that you're only providing them with what they want and you are sending them what they ask for. Now, keep in mind, and I hate to even bring this up, but it happens and I have to. So you never want to doctor, change anything that they ask. It has to be formal documentation. It needs to be real and it needs to be correct and accurate. And there's a lot of things you can do to minimize the stipulations. For instance, if they're asking for your articles of incorporation, that typically means that you don't have them filed with the state. They couldn't find them. So maybe your business address is located in a state different than the state you filed, and they looked and they couldn't find it. Well, prevent those requests and just get them, make sure there's a good paper trail for them to find that information and that it's the same on all your records. If you moved and they see multiple addresses on all your different records, that's a red flag. There may be a whole new stipulation list based on a different address on every single statement. Okay, so you want to make sure everything's clean, organized, addresses, business names, everything's correct and the same on all documentation. Put at the bottom much, much more because there's so much more we could go over, but we only have so much time today. As you know, our advisor team is here to help. We're here to help you through this process. That's what our goal is in the Business Finance Suite. And it's important to think like a lender. And I hope this information will help. I hope it will help you in the long run and today as you look at your business objectively and think about what you can do now to increase your fundability. Can you make sure all your deposits are flowing through your business checking account, building your business credit, making sure your personal credit stays clean and monitoring it. There's so many things you can actively do now to increase those opportunities you have in finance. So it's a pleasure speaking with you today. Let's check and see if we have questions before we go. We don't have any, so thank you so much for joining us today, and please feel free to reach out to the advisor team. Our phone number is 800-497-0499. You can also email the advisor team, advisor@businessfinancesuite.com. Our office hours are 9 a.m. until 7 p.m. Eastern Standard Time. Have a wonderful day, everyone, and we will talk with you again next week.